Hello viewers, my name is Lascelles Chen and I am a banking and finance professional specializing in microfinance. Today I want to teach you how to establish your own community bank. A community bank is a savings and loan operation which a group of people, a private group of people, establish for their own benefit. A community bank is an informal operation, and the technical name for a community bank is a mutual society. It is a group of people, a society that has a mutual understanding. So the technical name is a mutual society. The laws do not restrict individuals from carrying out savings and credit activities amongst themselves. So in summary, the central bank does not regulate or supervise the activities of mutual associations. And it is very simple because these are people who have independently decided to carry out a certain operation, and they have accepted their own rules and regulations, and their activities do not impact on a second party. We say mutual association. Now the association is the equivalent of the community when we say community bank. So this community basically is made up of people who have decided to work together. So it can be at any socio-economic level. It can be for poor people, saving $1 a week, or it can be for rich people, saving whatever amount they can save a week, $500, $1,000, it doesn't matter. It's the same principle. However, we need to give respect to the methodology itself, which was actually devised in the microfinance space. The specific methodology I will be training on is called the Grameen Microfinance Methodology, which was established by Professor Yunus in Bangladesh from the Grameen Bank. So even though it's a methodology that was designed to help poor people to be self-reliant and for a system to be self-financing, the methodology lends itself to any group of people at any economic level. So it's an ideal methodology for a community bank, a group of people who want to work together to save and borrow together without any outside influence and any laws that would try to direct them in what they should do. So this video is to help you to establish and manage your own community bank. In some countries, the word bank is regulated by the law, but in microfinance we use these terms very loosely because it is the jargon that we have been using over the years. The Grameen methodology that we will be using, it is a mathematical based methodology, and it is very easy to implement, and we hope that you will be able to follow the video and establish your own bank in your own community. You're welcome. The methodology that we're going to be showing today is called the Grameen Microfinance Banking Methodology. And it's a group-based methodology, and it is founded on savings. So I want to walk you through the 6 defining principles of the Grameen Microfinance Banking Methodology. Number 1, the basic group is 5 persons. So you cannot have less than 5 persons. And this basic group will be further subdivided into 3 groups in the ratio of 2 to 2 to 1, with the chairperson of the group being in the last subgroup. We will revisit this again when we discuss the issue of loans. Number 2, weekly compulsory security savings. The group must decide on how much each member is going to save every week. So you will find a group, depending on their economic status, they may decide to save $1 each person. Another group may decide to save $5 each person. So each group is self-selecting, and they must decide how much they will save every week. Now, this is compulsory. Whether you have a loan or you don't have a loan, this weekly savings is compulsory. You cannot withdraw, and all the savings will be refunded at the group maturity. Number 3, cross guarantee. Cross guarantee means that each member pledges to pay for any other member in the group who is in arrears of savings or loan repayments on the designated meeting day. So this is the strength of the group, and this is why we need persons who know one another very well, who trust one another, and who will not become a burden to the group, but who are willing to comply and save and respect their obligations. Number 4, savings to loan leverage. The leverage is the multiple of the savings to determine the loan value. So this means that the individual's loan value will be twice his or her savings balance. Number 5, group tenure. The group members will decide how long they will be together as a savings and loan group. It must not be open-ended. So the group can decide to be together for 24 weeks, which is 6 months, or 52 weeks, which is 1 year. Number 6, staggered loan rotation. Loan tenures are 4 weeks. These are short loans. And loans are disbursed starting from week 5. Then loans go out in week 7 and in week 9 in the 2 to 2 to 1 ratio. Group members will get their loans in their respective subgroups, and the chairperson is always in the last subgroup to receive their loan. So if a group has 5 members, we can see 2 persons, then 2 persons, then 1 person. If the group has 20 members, then we are seeing 8 persons getting loans, then another 8 persons getting loans, and then 4 persons getting loans. So that is what we call the stagger. The rotation is after an individual has finished paying their loan, the 4 weeks, there is a rest period of 1 week, and then another loan will be offered to them, which will be twice their savings, which of course has gone higher. So that is the rotation. So in microfinance we talk about a staggered rotation. And those are the 6 defining principles of the Grameen microfinance banking methodology. Viewers, we will now move forward with the actual steps to establish the community bank. Now the first step is to establish the group, and this is very important because the group members must know one another and trust one another, and this is the basis of the operation of a Grameen banking model. In the group formation, there are 6 decisions that the group has to make. Number 1, the number of persons in the group. If the group was pre-existing and it had more than 5 members, it is okay to go forward because the friendships are already established. But if you're starting a new group, we urge that you start with a group of 5, 6, 7, a small number, and you can grow later on. The second decision is who is the leader of the group. The group must have a chairperson, and that person will be the banker. That person will be responsible for the money. Number 3, weekly savings amount. The group has to decide on how much each person will save every week. It is a common amount, and that means that the group would normally come from the same economic level. So you may find a group of persons selling in the market forming a group with their friends and family, and they are saving at a certain level. Or you may find people in the office who are earning a higher income, saving at a higher level. So the group has to decide, and everybody will agree, yes, this level of saving is okay for them. Weekly saving. The 4th decision is the payment day. Which day of the week will the members be required to make their savings? Number 5, interest rate per month on the loans. These loans are for 4 weeks, and which is 1 month, so the group should decide what is the interest rate on those loans. This is very important because it will make sure that the value of the fund is not depreciated by inflation. So you find some groups charging 5%, some groups charging 10%. It also affects the amount of money that the members will receive at the end when the group matures, maybe after 6 months, maybe after 1 year. Number 6 is the payment mode. Please choose a single payment mode to avoid confusion. But of course the group will decide. You will either make your payments in cash, so this is a matter of getting the money to the chairperson, the banker, or in some countries you have e-money facilities from your mobile network operators or your banks. So choose your payment mode. The chairperson has a number of responsibilities. And these include group cohesion, making sure that the group is happy together, working well together. The chairperson is also responsible for the training of the members, the timely training. As they move forward, they are trained. So you're trained on how the group is put together, how to make the payments, how to take the loans, and so on. The chairperson should also be monitoring the members, monitoring their behavior, monitoring their outlook on the bank, make sure that they are making maximum use of the services. Arrears management, a very important aspect for the chairperson, and it is their responsibility to implement the cross guarantee if required. Very importantly, at the end of every payment week, it is the job of the chairperson to communicate the fund balance to each member, because the bank belongs to every member. Next step is to look at the ledgers that will be needed in the establishment of the community bank. Now, there are basically two ledgers. One ledger is for the individual, and the other ledger is for the chairperson and the banker. And these ledgers are very simple, as you can see. For the member ledger, it has 4 columns. We have the week number, so that will go from 1 to 24 or 1 to 52, depending on your group tenure. Then you have 3 columns, one for your payment, one for your savings balance, and one for your loan balance. The second ledger is kept by the banker, the chairperson. This is the group ledger. And this ledger is to show what is the cash balance at the end of each week. So you notice it has 4 columns again. One for week number, one for collections, all collections, savings, loan payments. Third column for loan disbursements, and the last column is the cash balance. So this information on the group ledger shows cash balance, and this is the balance that the chairperson will constantly communicate to the members. I will now walk you through the activities over a 24-week period as an example. Now here you see the agenda for each meeting. In week 1, all the members make their savings. 2, week 3, week 4, that continues. So here the members are making their savings and the chairperson is reporting on the balance. In week 5, members make their savings and the first 2 persons in group 1 receive their loans. Week 6, savings. Also in week 6, those first 2 members in the first subgroup make their first loan repayments. Week 7, savings. Subgroup 1, they are making their second loan repayments. And subgroup 2 are receiving their first loans. This is week 7. So you can see the savings and loan disbursement process happening. In week 8, again savings. The first group is now making their third loan repayment, and the second group is making their first loan repayment. Moving to week 9, again savings. Group 1 is making their 4th loan repayment. So Group 1 is finishing their loan repayments in week 9. Group 2 making their 2nd loan repayments. And Group 3 is receiving their 1st loan. So you can see how many things are happening in week 9. Savings are being made. One group is finishing its loan. Another group is making 2nd loan repayments. And another group is getting their 1st loan. Week 10, savings. Here we have now subgroup 2 making their 3rd payment, and subgroup 3 making their 1st payment. And notice subgroup 1 is not making any loan repayments because they had finished in the previous week. Week 11, savings again. Subgroup 2 making their 4th payment. Subgroup 3 making their 2nd payment. And you can see subgroup 1 is now getting their 2nd loan. Their 2nd loan. Remember, they got their 1st loan in week 5. Week 6, week 7, week 8, week 9, they repaid. They rest week 10, and now they are getting their 2nd loan. Of a higher value, of course. Week 12, savings. Group 3 making their 3rd payment. Subgroup 1 making their 1st payment. And this continues. Very easy to understand. The savings are being made every week, and the groups are paying off their loans and getting the 2nd loan. For instance, you can see there in week 13, subgroup 1 making 2nd loan repayment, subgroup 3 making their 4th loan repayment, and subgroup 2 is now receiving their 2nd loans. It continues and continues. If you look at week 15, you can see even subgroup 3 is receiving their 2nd loans. So all subgroups now have their 2nd loans in this 24-week demonstration. We even have in week 17, subgroup 1 is receiving their 3rd loan. Subgroup in week 19, subgroup 2 is receiving their 3rd loan. Now you will notice in week 19, subgroup 3 has made their last payment. But because we are only having a 24-week tenure, there is not enough time for that group to take another loan. So you'll notice in week 21, subgroup 1 is making their last payment. In week 24, subgroup 2 is making their last payment. And then in week 24, the fund balance, because the group is now closing, the fund balance is divided equally among the 5 members. We will now look at ledgers which have been filled for the first 14 weeks so that we can demonstrate the payments, the loans, and you can see how each ledger is to be maintained. Now the first ledger we will look at is the individual members ledger. Here we see a ledger which has been filled by the member, and you can see for the first 4 weeks the member is saving 1,000 shillings or $1,000, whatever it may be, 1,000 units. And you can see in the 3rd column the balance is increasing, and you see there is no loan for the first 4 weeks. In week 5, the member makes another savings, and that is the week when the loan goes to that member. Now the loan is for 8,000, but you notice the loan amount is showing the interest due also. This is 10% interest. So in that week 5, two things have happened. The customer made the normal payment of savings, and the customer received 8,000 for a loan, and the customer has recorded 8,800 to be repaid. So the last column is showing principal plus interest. In week 6, the repayment of the loan commences. So you noticed in the second column, you have 1,000 for savings and 2,200 for the loan, against the loan. So the savings column goes up, savings balance goes up to 6,000, and the loan balance goes down to 6,600. And this continues up to week 9. You see the 4 payments there, 1,000 plus 2,200. You see the savings balance going up, and you see the loan balance going down. So the final payment on the loan was made in week 9. Then week 10 is what we call a rest week. Week 11, but you notice in week 10 the savings continues, and savings is in every week, as you will notice. In week 11, the member gets the second loan. So this is what we are talking about, rotation. Now the second loan is 2 times 10,000. So the second loan is 20,000 plus 10% makes 22,000. So that is why in week 11 you see 22,000 for the loan amount, which is principal plus interest. It is 20,000 plus 2,000. Then the repayment begins in week 12. There you see the savings plus the loan amount payment, the loan payment, which is 5,500. So in week 12, the savings goes up to 12,000, and the loan amount starts to reduce, and it reduces by 5,500 every week for the next 4 weeks. And this continues on and on until the maturity of the group. If the maturity is 24 weeks or whatever number of weeks you decide, maximum 52 weeks, this is what the ledger of the individual would look like. Of course, different individuals would be getting loans at different stages. So this ledger represents the first group, the group that get their loans in week 5. The second group would get its loan in week 7. And the last subgroup would get its loan in week 9. So you would just see the loans going out at different times. But the accounting basically is the same. The second ledger we are looking at here, kept by the chairperson, and you can see that this is the group cash accounting. In the first week, there are 5 members, so 5,000 is collected by the chair, and the balance is there 5. And for every week, 4 weeks, the chairperson collects 5,000, so the balance is 20,000. Now, in the 5th week, remember, 2 persons are getting loans of 8,000 each. So there you have loan disbursement, 16. and the balance is now 9. In week 6, they start to repay, and you see the repayments there of savings and loan. The balance goes up to 18,400. In week 7, the payment continues. But also in week 7, 2 more persons are getting loans of 12,000 each. So that's a 24,000. So the new balance is now 3,800. You will notice how the balance is going up and down depending on savings and loan disbursements. But the balance never goes to 0 or below. This is the methodology. It's a mathematical methodology. So in week 8, we now have 5,000 savings. The first group is still repaying its loan. The second group has started to repay its loan. So the cash balance goes from 3,800 to 19,800 on the collection of those payments. In week 9, we have the collections coming in, but we have now the third subgroup, which would be the chair, including chair. That loan is 16,000. So 19,800 was the balance. We collected 16,000 and we made a loan for 16,000, so the balance remains at 19,800. In week 10, payments come in, the balance goes up to 35,800. In week 11, payments come in, but the loans going out are now 40,000. So, which are 2 loans of 20,000 each. So the balance goes down to 11,800. Week 12, payments come in, the balance goes up to 32,200. Week 13, payments come in, loans go out again, the balance goes down to 4,600. So this continues until the end of the group life. But the important lesson here is that the cash balance never goes to 0 or negative. And this is the strength of the Grameen microfinance banking model. It is self-reliant. The members are putting in the money, the members are borrowing, the members are repaying with interest. It is self-financing. It does not need any inputs from outside, as you can see from the cash balance. We shall now look at the performance results for a community bank where its members save 1,000 units weekly. From the table you can see we are looking at 2 tenures, a 24-week tenure and a 52-week tenure. If the group decides to stay together for 24 weeks, 14 loans will be disbursed among those 5 individuals. Those loans valued at 308,000. At the end of the 24 weeks, the group fund balance will be 145,800. That means each member will get a payout of 29,160, and they had saved 23,000, so they are earning 6,160 on top of that 23,000, which translates to a rate of return of 26.8% over 6 months. If the group decides to stay together for 1 year, a total of 35 loans will be disbursed among those 5 individuals. And those loans will be valued at 1,652,000. The group fund balance at the end of the year will be 407,400, which means each member will earn a payout of 81,480, having saved 51,000. So they are earning 30,480 on top of that 51,000, which translates to a rate of return of about 60% per annum. So you can clearly see that a community bank benefits its members through savings mobilization, through loans, and through very attractive rates of return when the community bank matures. Now we want to mention a few outstanding issues, and the first is changes in group membership. You can add members to the group, but they must deposit the equivalent savings balance that the members have. For example, if a new member comes in at week 13, they need to bring 13 times the weekly savings. And then after they save for 4 weeks, they will be able to get loans. The second issue is removing members. Sometimes a member would like to exit, or for disciplinary reasons the group may decide somebody has to go. Well, first of all, that individual must have repaid all loans. If they have repaid all their loans, then when they are leaving, they will get a savings refund without interest. Additional issues for consideration. Now, in the example, we have shown a loan tenure of 4 weeks. The group can decide to have a longer loan tenure. The mathematics remains the same. The payment period. Now, in our example, we had weekly meetings, but a group may decide they want to pay monthly. So instead of calculating weekly, we would calculate monthly. Some people would like to prepay their loans. That is allowed, but you have to pay the full balance, and you still have to wait until your time comes around for your next loan. So prepaying a loan does not move you up in the line, and even prepaying on your savings does not affect the calculation. The calculation will be based on the number of weeks of savings. So if you are supposed to have 12,000 savings, but you have 14 or 15,000, the loan will still be calculated on 12 weeks savings. Now, some groups decide that the chairperson, the banker, will keep the money at all times. I have seen other groups where the cash custody is rotated. So the chairperson does the accounting, and the cash custody is passed to someone else. So when we come to the next meeting, that person brings that cash, they do the accounting, and the new balance is passed to another person. So it's just for the group to decide how they want to manage themselves. Item 5 is grievance committee. Now, even though people become members of the group with all good intent, sometimes things don't work out. So it is wise for the group to have a group of 5 to identify 2 persons to be in waiting as a grievance committee, just in case an issue comes up. So these are just 2 members, not including the chairperson. From my experience, I have not found it necessary for groups like from 5 to 10 members. But I have seen in some instances above 10 members, surely above 30, where a grievance committee is there to help the members to sort out the issues and to keep the group moving forward. Well, viewers, that brings us to the end of this training video. I hope that you have been able to follow. If there are any inquiries, please don't hesitate to contact us on the email, and we are more than willing to assist. Wish you a very pleasant day. Thank you very much.